Guten Tag, ladies and gentlemen. Financial Ape here. Welcome back to another video. Thank you all for the continued support. It means a lot. In today's video, we'll be discussing the anatomy of a bear call spread. A bear call spread, otherwise known as a call credit spread or a credit call spread, they're all the same thing. You can use those words interchangeably. This is a strategy with a bearish outlook. If you believe a stock is going to drop, you can use the bear call spread to generate some profit. So, the stock of interest today is the S&P 500, the SPY, which is an ETF that is tracking the performance of the S&P 500. If I believe the SPY is going to go below 440, I could select that as my call price, and I'll select 441 also as a call price. I'll explain to you why I'm doing this in a minute. So I go to profile and I'm going to short, very important. Remember to short the lowest strike price. All right, so now it's red and then I have blue. The blue means buy, the red means sell. And to verify that this is a bear call spread, what am I going to do? I'm going to go to trade and look at that. It's a bear call. I know it doesn't say spread, but this is a bear call spread. Go back. And now let's take a look at the P&L profile. It says here, because I'm shorting a call and then long a call at a higher strike price, that's extremely important to note. You have a short call and then you have a long call at a higher strike price. So two strike prices. One that's short, which is always the lowest strike price, and then you have one that's long, which is the highest strike price. That creates a call credit spread or a bear call spread. So take a look at the P&L profile here. We have our max return, which is 40. That's what we're getting up front. Notice how we're getting money up front, so it will result in a net credit. And we have a max loss of 60. Now, where do they get this number, this $60 from? Very simple. Let's go here for a second. We have 440 and 441. What is the difference between 440 and 441? Well, it's 1. But remember, in the options world, we always got to multiply something by 100. So we actually get 1 times 100, which is 100. And that's the margin impact here. That's what you're putting as collateral. You're putting $100 as collateral. You're getting $40 right away. And you have a max loss of $60, right? You cannot lose more than $60. That's what it means by max loss. And obviously the minimum invest is always going to be approximately equal to the credit. Always approximately equal to the credit. So what does this mean? Well, it means that I'm bearish on the S&P 500. I think it's going to go below 440, right? That's what a bear call spread implies. You do not use this strategy if you're bullish. It has the name bear in it for a reason. Take note of that. So, what does this mean? It means by October 15th, which is 19 days away, if the S&P 500 is below 440, I make money. I make all the money I want, right? It can go to zero and I'll still make the max profit, which is $40, right? It doesn't matter how low it goes. All you care about is that the stock expires below 440. That's all you care about, all right? If it lands on 440, that's okay too. If it lands on exactly 440, that's fine. You still make the max profit and you get your full credit back, your margin impact. You get the full collateral back. So, what happens though if the S&P 500 expires at 440 and 1 cent? That's a very good question. Any cent or for every cent above this 440 number is a dollar knocked off your collateral. Remember, the margin impact represents the collateral you need to put up in your margin account in order to activate this strategy. So for every cent above 440, you lose $1 of this collateral. So if the S&P 500 lands on exactly 440 and 1 cent, you'll still keep this for $40 in credit. But you won't get back $100. You'll get back $99. Same thing. If it lands at 440 and 20 cents, right? You'll keep the full credit, but you won't get back $100. You'll get back 100 minus how many cents was it over the 440 mark? It was over by 20 cents. And remember, in the options world, we take that 20 cents and we multiply by 100. So that's $20 knocked off, and we'll only get back a margin of 80. All right? So as you've noticed, if we go all the way to 441, well, it's now 100 cents or $1 above our short call price. So we lose this entire $100, right? But we got 40. We got 40 in the beginning, right? Because this strategy results in a net credit. So we got 40 in the beginning, but we lost the full 100. So our net loss is actually 60. We gained 40, but we lost 100, which results in a net loss of 60. That's why your max loss is 60. By the way, even if the SPY expires at 442, you will also have a loss of 60. If it expires, let's say at 463, the same thing. You will not lose more than this $60. That's why I always highly encourage all of you to assess your P&L profile. You need to know what you stand to make and what you stand to lose with every strategy before even opening the strategy. You need to understand what you will lose and what you will make before you open the strategy. Always. So that's the bear call spread. But I don't like this visual representation. As you guys know, I'm not a big fan of this visual representation on Interactive Brokers. So we're going to go ahead and use OptionStrat, my favorite website. Look at this. Tell me this is not more visually appealing. So beautiful. So we're going to construct the same strikes. We have the 440, which is the short call. And then we have the 441, which is the long call. The way it works on OptionStrat, which is this website, any call above this line, like here, the 441 is above this number line, that means it's long. Anything below the number line, like the 440 here, means it's short. So in order to construct a bear call spread, what do we need? Well, we need two strike prices. We need one of them to be a short call, right? And one of them to be a long call. Now, which one's which? Well, the short call is always going to be the lowest strike price, and the long call is always going to be the highest strike price. So this is what we get when we're using OptionStrat. The numbers are a little bit different because it's the weekend and the options market is not open yet, but it's the same principle. You get your break even, right? And anything below the 440 is obviously profitable. It's always going to be profitable, okay? Anything above the 440 is when you start losing money. And notice you can't lose more than a certain amount. It says negative 13 here, but on Interactive Brokers, it's 60. Right, the numbers are a little bit off, but the concept has not changed. It's still a bear call spread. The only reason we have different numbers is because it's the weekend, and OptionStrat, I believe, is delayed. But it's still the same principle. You have here 440 strike price, which is the lowest strike price, and anything below, see all this green? This means you make money. and it doesn't go higher than $87, right? Because that's the max you can make. You cannot make more than $87. And you have negative 13 here because that's the max you can lose. Just pretend this negative 13 here actually says minus 60 or $60, right? And think of this net credit here as $40, right? Just like it says here on Interactive Brokers. So this is a bear call spread. Remember, it's constructed when you believe the stock is going to fall and you short one call price or a one call strike, and then you long another call strike. And remember, the short strike is lower than the long strike. That's the bear call spread, otherwise known as a call credit spread, a bearish strategy. It's essentially like a put. However, you have limited losses and you also have limited profit. Thank you all for watching. Hope this helps. Have a wonderful day.